Okay, here's a thought. What if there was a kind of strategic blueprint, something to really amplify your charitable giving, making sure, you get more impact for the causes you believe in, but also unlocking potentially significant tax savings for yourself? Well, today, we're not just cracking that code, we're basically handing you the master key. Welcome to the deep dive. We are plunging today into, well, it's a fascinating world, often misunderstood, maybe, but it touches nearly everything. Schools, hospitals, the charities we support, even, the political landscape. We're talking about the intricate but incredibly powerful world of tax-exempt organizations.
And what's really compelling, I think, is how understanding these structures, these different types, can give you, our listener, a much, much clearer picture, a picture of how these vital entities operate, and maybe more critically, how your contributions can be, let's say, strategically managed for maximum benefit, both for the causes you care about and, importantly, for your own personal financial well-being. This isn't just about being generous, it's about smart, impactful giving.
Exactly. That's precisely the mission for this deep dive. We've gone through the sources, tried to unravel the complexities, pull out the actionable intelligence. We're going to focus specifically on what qualifies these diverse organizations for their unique tax status, and crucially, how your support for them, your donations, can directly influence your own financial picture, your tax situation. Our goal here is to equip you with solid, practical knowledge, something that empowers you to make genuinely informed decisions with your hard-earned money, your generous spirit, turning, simple acts of giving into maybe more sophisticated financial strategies. Okay, so let's lay some groundwork. When we talk about tax-exempt organizations, what are we defining here? At its most basic level, right? These are entities structured as not-for-profit. And because of their very specific purposes, how they operate, they qualify for an exemption from federal income tax. And we're not talking about some small niche group here. This is a huge part of our economy, our society.
Absolutely. And that not-for-profit part. That's the absolute linchpin. It fundamentally sets them apart from any for-profit business you might invest in or deal with. Think about it. A typical company, their goal is profit, surplus revenue, which then gets distributed, right, to owners, partners, shareholders. A not-for-profit, though, it exists for a specific mission or purpose. It could be educational, charitable, religious, scientific, whatever. Some kind of public benefit. Any money they bring in beyond their operating costs, and this is key, has to be reinvested entirely back into the organization, back into furthering that specific mission. It can't just be, siphoned off as dividends or huge bonuses beyond reasonable pay. It can't be distributed as profit to individuals. It's a structural thing. It ensures every resource, every dollar, every asset is channeled towards their stated public benefit, not private gain. It's a legal commitment, really, an ethical one, too, defined by their founding documents and, of course, by the IRS tax code. Very detailed guidelines there.
And okay, when we dig into this idea of tax-exempt organizations, it's definitely not just one big blob. What's truly remarkable, and we saw this in the materials, is just the sheer variety within this sector. It's huge. The IRS actually designates, get this, over 30 different types under Section 501C of the Internal Revenue Code. Imagine that. Over 30 distinct categories, each with its own rules, its own nuances. It's like this complex, thriving ecosystem, specialized organizations working across pretty much every part of society.
Exactly. That diversity, it isn't just random bureaucracy. It really shows the vast range of societal needs and activities that go way beyond just, buying and selling things. From like the smallest local garden club all the way up to massive national research foundations. The tax code has carefully carved out specific categories to support this huge range of activities. It's like the law recognizes that public benefit comes in tons of different forms. And that naturally brings up a big question for all of us, doesn't it? How do we, as individuals, as citizens, navigate this really varied landscape effectively? How do we make sure our efforts, and maybe more importantly, our financial resources, our donations, go to the right places? Places where they'll have the impact we want, but also maybe bring us the personal financial benefits, like tax savings, that we might be looking for. This is where really digging in, doing this deep dive starts to empower you.
That's a really crucial point because, yes, there are over 30 types, but the sources make it crystal clear that the one that's by far the most common and probably the most impactful for most of us, especially when we're thinking about charitable giving, about our own tax strategy. Yeah. That's the Section 501c3 organization. This is the designation you hear about all the time, right? It's stamped on your local church, big universities, hospitals, and there are very, very good reasons for that prominence, reasons that connect directly to your tax return.
Precisely. That specific 501c3 designation, it comes with some really distinct characteristics. Profoundly distinct, actually, especially as you said when it comes to the deductibility of contributions, which, let's be honest, is often where a donor's practical interest really kicks in. It's the main way, the most accessible route for individual giving to directly mesh with and significantly boost their tax planning.
Yeah.
So understanding the ins and outs of the 501c3 isn't just helpful, it's absolutely fundamental if you want to strategically maximize both your charitable impact and your potential financial savings. It's really the cornerstone of smart giving.
Okay, so let's peel back those layers. Let's really dive deep into this mighty 501c3. You called it the gateway to tax-deductible giving. I like that. What exactly qualifies an organization for this incredibly valuable 501c status? It seems to boil down pretty unequivocally to their fundamental purpose and how they actually operate day to day. Our sources detail a very strict requirement, non-negotiable. They must be organized and operated exclusively for one or more of a very specific list of purposes. It's not enough to just, do good work. That work and the organization's whole setup has to fit squarely into these predefined legal boxes.
You've nailed the core of it. These purposes, they aren't just suggestions. They're the actual scaffolding, the legal foundation for a 501c3. Let's maybe walk through them systematically. Give a bit more context, some real-world examples maybe. Okay, first up, religious purposes. This is broad. It covers your traditional houses of worship, churches, synagogues, mosques, temples, but also things like interfaith councils or religious charities doing outreach based on their faith. Think of like a soup kitchen run by a church or educational programs at a synagogue. If it furthers their religious mission, it generally fits. Next, and this one's maybe the broadest, charitable purposes. This is where you find organizations dedicated to helping people, relieving poverty, distress, helping the underprivileged. So homeless shelters, food banks tackling food insecurity, disaster relief groups responding to crises, groups helping refugees resettle. They're addressing basic human needs, public welfare, making society better, often providing immediate, tangible help. Then there's scientific purposes. These are all about research and discovery, various fields. It could be a medical research institute working on cures for diseases, or an observatory looking at the stars, an environmental center studying climate change. Their whole goal is expanding human knowledge, contributing to progress way beyond just themselves. There's a unique one, testing for public safety. These are organizations that do rigorous testing to certify products are safe for us to use, like an independent lab testing electrical appliances to make sure they meet safety standards before hitting the shelves, or an organization that checks if fire suppression systems actually work. They're critical watchdogs, really, protecting consumers, ensuring public well-being. Literary purposes. This is about promoting literature, literacy, the written word. Think public libraries giving everyone access to knowledge, literary magazines publishing new writers, critical thinking, organizations supporting writers, running reading programs in underserved areas, maybe even preserving old historical texts, fostering culture through writing. Educational purposes, super common, really diverse, covers the whole spectrum, elementary schools, high schools, colleges, universities, but also less formal places that still educate, museums, art galleries, zoos, botanical gardens, even public broadcasting stations, like PBS or NPR affiliates. Their goal is teaching people, developing individuals, or educating the public on useful subjects, fostering knowledge, skills, cultural appreciation. Okay, another specific one, fostering national or international amateur sports competition. This is important for developing athletes, but, and this is a big but that often trips people up, none of its activities can involve providing athletic facilities or equipment. So imagine an organization promoting youth soccer leagues by setting up tournaments, coaching clinics, or a group organizing amateur bike races. They focus on the competition, developing athletes, sportsmanship. But they can't own the soccer fields or provide the racing bikes directly. That keeps them from competing with, say, for-profit gyms or sports complexes. And finally, prevention of cruelty to children or animals. Think animal shelters providing sanctuary, adoption services, humane societies advocating for animal rights, or advocacy groups working to protect children from abuse, neglect, exploitation. They safeguard vulnerable groups, basically, ensure their safety and well-being.
Wow, that's a really comprehensive breakdown. And it's so important to get that this isn't just some random checklist for the IRS, right? This detailed list of purposes, it's the very foundation of why a 501c3 exists. It fundamentally ensures these organizations are genuinely serving the public good. It's the main legal framework for judging if they qualify for that significant tax break. It really is the IRS being meticulous, trying to safeguard the integrity of the whole charitable sector. Okay, now let's pivot. Let's get to where this information becomes really actionable for your personal finances, your philanthropic goals. This is where, like you said, the rubber meets the road for anyone looking to optimize their giving. Our sources are crystal clear on this unique powerful advantage. Unlike pretty much all the other types of tax-exempt organizations we're going to talk about, contributions made to Section 501c organizations, they qualify as deductible charitable contributions for you, the donor. This isn't some minor footnote. It's a cornerstone of strategic financial planning. It directly hits your wallet.
It really is the core tax-saving benefit. For individuals, for corporations too. And understanding the depth of this can totally change how you approach giving. When you support these specific organizations, you're not just being generous. You're actually engaging in a powerful form of tax planning. If you itemize deductions on your federal tax return, and for many people, especially those making larger contributions, this is a key strategy. These donations can directly lower your adjusted gross income, which in turn lowers the amount of income subject to tax, so it directly cuts your overall tax bill. But wait, the strategy gets even deeper. It's not just about deducting cash. Think about donating appreciated assets, things like stocks or mutual funds you've held for over a year that have gone up in value. If you just sold those assets yourself, you'd owe capital gains tax on that profit, right?
Right.
But if you donate them directly to a 501c public charity, you can often deduct the full fair market value of the asset on the day you donate it. And you completely avoid paying the capital gains tax on that appreciation. It's like a double tax benefit.
Wow. Okay.
Yeah. It can lead to significantly bigger savings than donating the same amount in cash.
Yep.
Especially for people holding stock that's gone way up, but they bought it low basis stock. This can be an incredibly powerful tool for both your giving goals and managing your own wealth. It's a direct incentive baked into the tax code, designed not just to encourage giving generally, but specifically giving to these causes the government sees as beneficial. It's almost like a partnership. The government, the charity, and you, the donor. Everybody wins.
Okay, so let me just reiterate that because it feels really key, especially for the tax savings focus. If your goal is supporting a cause you really believe in, A&D, at the same time you want to optimize your tax situation, strategically cut down your taxable income, then understanding this 501c designation and how you can leverage it, like with appreciated assets, it's not just nice to know, it's absolutely essential. It's the first most critical step to becoming a truly strategic, impactful donor. Moving beyond just generosity to, well, sophisticated financial thinking.
Exactly. It's all about being informed, effective, and empowered as a donor. It changes your giving from just a simple transaction into more of a calculated, impactful investment, an investment in the public good, with real, tangible benefits for your own financial situation. Okay, even within this powerful 501c3 world, there's another crucial layer, another classification our sources highlight, and this one deeply influences how an organization operates, how it gets funded, even the small print on how your contributions are treated. 501c3s are primarily broke down into two main subtypes, private foundations and public charities. And getting this distinction, it's key to really understanding their operational styles, their accountability, and how your philanthropic dollars might ultimately make an impact.
That is a truly critical point for digging deeper. So here's how it works. By default, any organization applying for 501c3 is initially classified as a private foundation, unless it actively proves it fits into certain specific excluded categories in the tax code. So this default status means the IRS basically assumes a 501c3 is a private foundation until proven otherwise. Now, for a private foundation to keep its tax-exempt status, and maybe more importantly for donations to it to remain tax-deductible for you, the donor, their governing documents, that means their foundational legal stuff like articles of incorporation, bylaws, they must include some very specific rules. Those aren't optional. For instance, they have to include a requirement that the foundation distributes a certain percentage of its income and assets each year. It's required by tax law. People often call this the payout requirement. And it's crucial because historically, there was concern that foundations might just hoard wealth, right? Not actively use it for charity. So the law typically says they have to distribute at least 5% of their average net investment assets annually. If they don't, big excise taxes. A powerful nudge to keep the money flowing towards the mission, not just sitting in endowment. Plus, private foundations are strictly, and I mean strictly, prohibited from engaging in any self-dealing.
Self-dealing, what's that exactly?
It's a rule designed to stop founders, their families, major contributors, from personally benefiting from the foundation's money or assets. So transactions between the foundation and these disqualified persons are heavily restricted. For example, a founder can't sell property to the foundation for way more than it's worth, or use foundation funds to pay for personal stuff, like a yacht or a fancy vacation. It's a really strict rule to keep things focused on the charity part. They also can't hold excess business holdings.
Basically, they can't own too much of an unrelated for-profit business that could distract them from their charitable purpose. It's all designed to ensure the foundation's assets stay purely for public benefit.
Okay, that makes sense. And how do these private foundations usually get their money? And what's their main way of operating in the charitable world?
Good question. Characteristically, private foundations get the vast majority of their funding from a single major source, often a wealthy individual, a family, maybe a corporation. They don't usually rely on broad public fundraising campaigns like, say, the Red Cross. This concentrated funding often means their philanthropic focus is also more concentrated. It might reflect the specific interests or vision of the founders. And here's another key difference. Their main activity is usually making grants, giving money to other charitable organizations or sometimes individuals. They typically don't run programs or services directly themselves.
Ah, okay.
So a private foundation might give a big grant to a local homeless shelter to help it run. But the foundation itself wouldn't be operating the shelter, hiring the staff, serving the clients directly. This structure lets them act as major, often stable, funding sources for lots of different causes. They can focus on strategic giving, helping other charities build capacity, tackling big systemic issues, rather than the day-to-day of direct service.
Okay, so that's private foundations. Then on the flip side, we have public charities. These are the 501c3s that manage to fit into those excluded categories in the code, meaning they're specifically not considered private foundations. And because of that, they're not subject to all those same super strict rules and restrictions that private foundations have to deal with. This classification usually means they have a broader base of public support, maybe a higher degree of public accountability, and often more direct interaction with the public they serve.
Yes, exactly. Public charities cover a much wider range of organizations, and the sources list several common types that most of us would recognize immediately. These include churches, schools, colleges, universities, hospitals, and qualified medical research organizations that are publicly supported. This covers most of our basic societal institutions, right? Your local church, your university, the community hospital system. They're generally automatically seen as public charities. Their very nature, their mission, their accessibility implies broad public benefit and support, even if a lot of their money comes from, say, tuition or patient fees. Then you have other broadly based, publicly supported organizations with limited investment income and unrelated business income. This is a more general category, but super important. It's for organizations that rely on lots of people giving. Think big names like the American Red Cross, the Salvation Army, or maybe your local community arts center. They get funding from many individual donors, corporate sponsors, maybe some government grants. The limited investment income and unrelated business income parts are key, though. It means their main support should come from the public, and their activities should relate directly to their mission, not just running a side business. Also included are not-for-profit organizations that support public charities. People often call these supporting organizations. It could be like a foundation whose only job is to raise funds exclusively for one specific university, a dedicated fundraising arm.
I see.
Or maybe an organization that provides admin or financial services to a whole network of public charities, helping them run more efficiently. They're like vital middlemen, helping resources flow to the main public charities. And finally, organizations that test products for public safety, we touched on these earlier, they do that vital, often unseen job of ensuring consumer protection. Because their benefit is so direct and broad to the public, they also get classified as public charities.
Okay, and you mentioned publicly supported. What's the actual measure for that? How does the IRS define if an organization is truly publicly supported? Our sources specify that at least one-third of their total support has to come from governmental units and the general public. That includes individual donations, grants from other public charities, even membership fees sometimes. But it excludes income they get from providing services related to their exempt purpose. So that's a clear, quantifiable line in the sand. It ensures they have a broad, diverse funding base, not just relying on one or two huge donors.
Yeah, that publicly supported rule is incredibly important. It dictates so much: their level of public engagement, their accountability, how they even approach fundraising. And if we connect this back to the bigger picture for you, the donor, public charities often have a much broader public interaction model compared to the more focused funding of private foundations. They're sort of designed to be more responsive to public needs because they rely on the collective generosity of many different donors. This often means more transparency, maybe a more direct, visible impact in the community. For you as a donor, this difference can influence how you feel about an organization, how accessible it seems, how directly it impacts programs, how widely its mission connects. Your individual donation, even if it's small, is part of this larger pool supporting an organization that's usually involved in very direct public-facing work. It often feels like a clearer line from your contribution to the impact you want to achieve.
All right, so we've really dug into the powerhouse 501c3. We've looked at private foundations versus public charities. But beyond this really prominent category, there's that whole other universe of tax-exempt organizations doing vital work, even if they operate under different rules. It's definitely important for us to understand this wider landscape, too, especially when you're thinking about why you might donate to different groups and what the implications are, particularly, again, from a tax perspective.
Absolutely. While 501c3s are quite rightly top of mind for giving because of the tax deduction, many other types of organizations contribute hugely to society, even if their structure doesn't offer that same direct tax incentive for you as a donor. Our sources highlight several common examples, each doing different things. We have civic leagues and social welfare organizations. These fall under 501c4. They're pretty common, often very impactful locally. Examples: well-known service clubs like Kiwanis or Rotary, neighborhood homeowners associations working to improve the area, volunteer fire departments, the backbone of safety in many towns. These groups focus mainly on community betterment, social good, promoting common interests locally. Now, contributions to them, generally not tax deductible. But people support them because they see direct, tangible benefits in their community, or feel a sense of belonging, or know a vital service is being provided. It's giving for impact, usually not for a tax break. Then there are labor, agricultural, and horticultural organizations under 501c. These support specific industries or professions. Think of a labor union fighting for workers' rights, or an organization promoting sustainable farming, offering agricultural education, or even groups organizing flower shows, gardening clubs. Their focus is advancing the interest, improving conditions for their members in that specific sector. Donors here are often members or people really invested in those industries. Their support helps the professional or hobby community grow. Business leagues, that's 501cs, like a chamber of commerce, a professional association, maybe a real estate board. They promote common business interests in an industry or area. They might lobby for helpful policies, provide networking for members, offer professional development. Contributions generally aren't deductible as charitable contributions, but for members, they might be deductible as a normal business expense. Motivation here is usually professional gain, economic development, industry advocacy, and veterans organizations for past or present members of the U.S. Armed Forces under 501c. Dedicated to supporting veterans, their families, fostering camaraderie, advocating for benefits. Now, some might qualify for deductible contributions under very specific rules, like if they're organized purely for public charity purposes. But generally, they don't offer the same automatic deductibility as 501c3s. Still, the reason people give is often profound. Patriotism, gratitude for service, wanting to directly help veterans.
That breadth really does show just how many different parts of our society, our communities, our work lives are supported by some kind of tax-exempt status. It's a massive, diverse umbrella. But this leads us straight to the absolutely crucial question for our listeners. Does my donation to, say, my local volunteer fire department, a 501c maybe, or my homeowners association, does that give me the same federal tax benefit as donating to a school or a research hospital, a 501c3? This is where that detailed understanding really, really pays off.
That is precisely the critical distinction we need to hammer home for every donor. And our sources also bring up another very specific, often talked about category: political organizations. Under Section 527, these are entities set up and run specifically to collect contributions or make expenditures for what's called an exempt function. And that function is all about influencing elections or appointments to public office. Their whole reason for being is tied to the democratic process, supporting candidates, voter education, registration drives, broader political advocacy.
And what's unique about their tax-exempt income? The sources say their income from contributions, dues, fundraisers, selling campaign stuff. It's tax-exempt only if it's specifically set aside or spent for those political exempt functions. So the money they raise for a campaign, for instance, isn't hit by federal income tax itself.
Exactly. That lets them operate within the democratic process, funding everything from grassroots efforts to big ad campaigns, policy research. But, and here's the crucial distinction for you, the donor, while the organizations themselves are tax exempt and their own income for political work is untaxed, contributions made to them are generally not tax deductible for you on your personal federal income tax return.
Ah, okay. Big difference.
Huge difference. It fundamentally separates donating to a political cause versus a charitable one in the eyes of the tax code. Supporting a campaign or party,
Vital for civic engagement, expressing your views. But the tax code doesn't incentivize that kind of giving with a deduction. It's a deliberate policy choice separating politics from philanthropy for tax purposes. And just to add another layer, people often ask about how do these 527s differ from, say, those 501c4 social welfare groups we mentioned. Well, C4s can do some political activity, but it can't be their primary purpose. And generally, donations to them aren't deductible either. The rules get tangled, for sure. But the key takeaway for you, the individual donor, if a tax deduction is a big part of your motivation, always check that specific 501c classification.
Okay, this feels like maybe the most critical point for impacting your tax planning, your philanthropic financial strategy. While, yes, as we've seen, tons of organizations beyond 501c3s are tax exempt under various rules, contributions made to them generally do not qualify as tax-deductible charitable contributions for the donors. This is the big takeaway, right? The definitive so what insight when you're looking at your giving through a tax optimization lens.
It's the fundamental difference, yes. And the core insight we really want you to leave with, supporting your civic league, your social club. Great for community building, local pride, professional engagement, contributing to a political campaign, absolutely vital for democracy. But those acts of generosity typically won't give you that direct federal income tax deduction you get from donating to a church, a university, a medical research institute, a 501c3. This really highlights the unique, powerful incentive tied specifically, almost exclusively, to 501c3s for donors. The tax code is intentionally built to encourage contributions to charitable, educational, religious causes by giving you, the donor, that direct financial benefit. It recognizes their profound public good. It's a deliberate policy choice in the tax structure, a powerful lever influencing where philanthropic dollars tend to flow.
Now, our sources do mention a few rare, very specific exceptions. So it's not like a 100% blanket rule with zero nuance. For example, contributions to a U.S. instrumentality, or maybe certain volunteer fire departments if they're made exclusively for public purposes. Sometimes those can be deductible. But, and this is crucial, these exceptions are few and far between. Their applicability is super narrow. You'd absolutely need to confirm the specific situation for any organization like that before just assuming you can deduct it.
Absolutely. Those exceptions are indeed narrow, highly specific, often linked to particular legal structures or direct government ties. The main message, the dominant rule for individuals looking at tax savings through giving, stays crystal clear. The 501c3 designation is paramount. Knowing this empowers you. It makes you a much more strategic, informed donor. It means you can intentionally channel your giving towards organizations that not only deeply align with your values, but also provide that tangible financial benefit via tax deductions. It effectively integrates your generosity into your broader financial planning, your wealth management strategy. Makes your philanthropic efforts even more potent, really.
So let's try and wrap this up. What does all this mean for you, our listener, as you navigate this complex but hopefully rewarding world of giving? The universe of tax-exempt organizations, it's huge. Covers an incredible spectrum of activities, services, local groups, global initiatives. But when it comes down to your charitable giving, and especially the potential for direct tax benefits, that Section 501c3 clearly stands out. It's the undisputed key player, the one consistently offering those deductible contributions to donors. It's your primary, most reliable path for blending thoughtful philanthropy with smart personal tax optimization.
And understanding those finer distinctions, 501c3s, then breaking those down into private foundations versus public charities, and then clearly knowing how all of those differ from other tax-exempt groups like civic leagues, C4s, business associations, C6s, political organizations, 527s. It's absolutely essential. It's not just about following the rules, about compliance. It's about making truly informed strategic choices. Choices about exactly where your money goes, the specific impact it makes, and how that impact ripples out, both for the organization you support and, yeah, for your own financial well-being. It's really about leveraging the tax code's own structure to amplify your generosity. Make your giving as efficient, as effective as it can possibly be.
So as you move forward, thinking about your own giving, how you engage with your community, maybe chew on this thought. How might really understanding these detailed designations, these specific rules and incentives, allow you to align your philanthropic efforts even more closely, more powerfully with your own financial goals? Think about how this knowledge empowers you, how it can help transform your support from maybe just a simple act of spontaneous generosity into a truly strategic investment. An investment in the causes you care most deeply about, ultimately allowing you to give smarter and maybe live a little better too.